Welcome to the Realty Plus Real Talk series, where we talk to industry experts and know their views and opinions and the real facts and figures. And in fact, in today's episode, we will be talking about a very crucial aspect of real estate, which is the investment and finance and liquidity that the industry is facing right now. And who else to talk about this than the man of the hour? We have with us Mr. Amit Goenka, Managing Director and CEO for Nisus Finance and Investment Managers and Nisus FinCorp Private Limited. In fact, Mr. Goenka has more than 16 years of core expertise in investment banking and direct banking and strategy. And in fact, he has come up with the latest fund, which we will talk about. But before that, Mr. Goenka, a very warm welcome on Realty Plus Real Talk series.
Thank you very much, Sapna. It's indeed a pleasure to be with you today, and thank you, Realty Plus, for the opportunity as well.
Mr. Goenka, like I mentioned that, Nisus Finance along with Dalmia Group, you jointly closed the first close of a real estate focused fund. So, and that too in such a kind of a scenario, which is quite an achievement. So how was your strategy for this fund?
So, Sapna, we've been investors over the last 12 years, and we have constantly believed that the need for housing in India is persistent. It will continue to be persistent despite the hiccups, provided you can find the right product, the right strategy, the right micro market, and back the right investments. So that strategy, that focus over the last 12 years has obviously reaped very high rewards and dividends for us. We have over the last 12 years under various platforms deployed close to about 2,000 crore rupees. My latest fund, which is a Dalmia Nisus Finance Real Estate Opportunities Fund, is a 500 crore offering, which is in the similar series. And clearly, I think we are still seeing that the demand for mid-income and affordable housing hasn't actually waned. Every day you hear of some large developer actually launching a new project, a very large scheme of 1 BHK, 1.5 BHK, small ticket affordable housing in key micro markets of the major metropolitans in the country. Also, what is interesting is that it is an unprecedented opportunity that COVID has brought for us, and which is something which our LPs were able to understand, that there is a certain amount of precipitating of stress across the sector because of a lack of capital. Clearly, after the NBFC meltdown, there is a lack of capital, and hence opportunities will become even more viable for alternative funds like us. B is that there are perception issues, and so hence, if you're able to find the right partner and pick up the right assets, you will actually do much better because they are more likely to actually succeed than everybody else. And those people who otherwise would have found cheaper capital will have to now come to us. And see the fact that real estate is a solid asset-backed investment strategy. We've seen a lot of volatility in debt capital markets. We've seen mutual funds and not having enough securities or enough monetizable assets. So the fact that we are backing asset-backed, monetizable asset strategies, which are at a deep discount to the market value, gives us a significant cover, a significant upside to ensure that the capital stays protected at all times and a reasonable return keeps on accruing to the investors from time to time. And that is the mantra for today. Every investor is seeking capital protection rather than great upside, having lost a lot of their shirt in the capital market meltdown and debt issues and commodities and what have you. So, that is really what has helped us, is staying true to our strategy, staying focused, and looking at a significant, deep discounted asset-backed strategy.
So I'm sure real estate is now back in favor with investors after, as you said, many have lost their shirts in the capital market. And the key is to finding the right partner. So do you see this is the good time for investment? Because many financiers, as we were talking earlier, are in a wait and watch position. They are a little careful in deploying funds. Is it the right time, good time to invest, according to you?
I think there is no better, or I think this is really an extraordinary opportunity for investors. What the pandemic or COVID has done is it has unearthed opportunities, it has unearthed stress, it has broken the cash flow chain of even the largest developers and allowed capital like us to participate alongside with them. This was something which was never available because the largest developers, the best opportunities, still found some ways to keep their cash flow going from internal approvals, from new sales, from some sort of bank finance, etc., etc. Now this entire financing chain has been broken. Now that allows us to plug in into that chain and ensure that the chain becomes stronger. So in my view, always we believe in investing when the chips are down and exiting when the chips are up. We don't go into a bullish market. We always go into a bearish market and we exit in a bullish market. So there is no better time, therefore, for us to actually get into the best deals and make a lot of money on them and exit at the right time when everybody else is entering into the bearish market, which is maybe another 24 to 36 months later.
Okay.
So I certainly believe that. Having said that, the dynamics of the housing sector is very, very interesting. We have almost about 2.2 lakh housing units of 1.5 lakh crores worth, which are yet to be completed and delivered. Of these, I can tell you that there are very, very low hanging fruits that one can go after. And if you take away NCR and some of the other pain points there, it's very easy to see that you can actually go after almost 70-80,000 crore rupees of nearly sold receivables of somebody who has already gone and bought the house, paid 50% of the money, and is waiting to just take possession over the next 12, 24, 36 months. But that project is getting stuck because of last mile financing, because inability of the NBFCs or banks to finance it, because of premiums having gone up, because of some disruption in the project which required more capital. Now that is a very, very interesting opportunity. To our mind, it is simply a receivable discounting or a securitization model, where we are not taking any new market risk, but simply saying, hey, here are customers who have invested close to 40-50,000 crore rupees. Another 40-50,000 crore rupees will get released when these investments or these assets are completed. And all we need to take is 1% of that pie. Correct. Which is 500 crore rupees of that pie. So 1% of this 50,000 crore cash flow opportunity is available in the marketplace today, which otherwise was not available so easily to alternate investment funds. The second thing is that today the largest developers, to anybody even with the largest assets, is willing to talk and willing to understand what it takes to see himself on the other side of this curve. And that means that he will need to shore up his balance sheet, need to take capital, even if it's slightly expensive. So today the cost of capital is not relevant. The availability of capital and the need to keep businesses and assets in motion, monetize it, keep confidence of customers, keep the stakeholders engaged, and not get out of the market because of lack of capital is absolutely paramount. And this means that they will need to plug in new capital into their system, whoever it is. And therefore, we certainly believe that this is an excellent time. Banks and NBFCs are not investing. We have raised money. Okay, and therefore, this will be the best time for us to make the best amount of money. And so, I think today our investors saying, hey, the repo rate may have dropped and I'm not getting 6-7% in the bank. Here I can easily make 18-20% per annum. With a 3x cover on my money, with an exit in 2.5 years. I'm making a multiple of 2 to 2.5x on my money over the next 4 to 5 years. So it's a very, very exciting time for somebody who can curate the right opportunity, go after these low-hanging fruits, and actually capitalize it and exit it before the markets again start getting bullish.
Sounds like a win-win situation, and more it's not like a lender or a borrower, but more like a partnership between the two to complete the project. And you mentioned about residential market having the low-hanging fruits. So what are the other asset classes which could offer, one is residential as you mentioned. What could be the other asset classes that can offer good returns?
So clearly we are living in a VUCA environment. There is volatility, uncertainty, complexity, anomaly and adversities which are facing the economy, and that is likely to continue for a few more quarters. And I think it is very pertinent that people are looking at flight to safety. So while affordable housing and development assets like us, and therefore investing through a manager like us is absolutely the best way to make money and put into a safe environment. I think there are 2-3 things which are likely to be emerging opportunities which will come up. If you look at it from a medium-sized investor, for a medium-sized investor looking at pre-lease commercial assets, which are let out to manufacturing companies, to healthcare companies, to pharma companies, to FMCG companies, which are seeing the best run today. So those assets which are going to be the core office spaces of these companies and are available today because asset owners which are sitting tight on these assets today are willing to let go of these assets because they need to create new cash. They need to monetize them, they need to shore up their cash, and they need to service their debt liabilities. So those assets which are pre-leased and are let out, and but be beware that it, ideally try and avoid what is let out to an IT sort of BFSI segment because they are going to face certain challenges. I think Tata Consultancy has already clearly said that we will have 75% work from home, and so many banking and ITs guys have pretty much said the same thing. So, but when it comes to core manufacturing, healthcare, FMCG, those people will continue to operate out of offices. So, I think that's a brilliant time. The leverage rates are down, LRD rates are down. The entry yields have inched up close to 9% or higher, which means there is a positive spread that one can take on actually buying these assets, and that is likely to give a very large upside going forward. Similarly, one can participate into investments into warehousing and data centers. Again, very core logistics, distribution, FMCG-led businesses, which again are very resilient, have shown resilience, will continue to show higher and higher growth and resilience going forward. And there are a lot of significant opportunities that are emerging in this space as well. I do believe that co-working will also be a great opportunity going forward, especially with the stronger players, because clearly we are seeing that there is a strategy of moving with a core and flex model across a lot of corporates. What that really means is that they will maintain a core office, but have a lot of flexible working spaces around various parts in the city, where their employees can stay close to their home, go to a co-working environment, plug into the central system, and get started. That way, they don't need to travel, stay out of their home for long. They don't need to come to offices. They don't need to crowd offices. They don't need to have an issue with the density norms and the social distancing and the health issues. So corporates are very happy looking at increasing their footprint in these managed offices or co-working spaces. I think that's a great opportunity right now for people to start looking at picking up stake in that or picking up properties which are getting operated by these co-working operators, because they will continue to have great demand from now the larger occupiers rather than the startups and the smaller occupiers. I certainly see that. And finally, I see that a lot of inventory is actually unsold, Sapna. There is an estimated 4.5 lakh units worth 3.5 lakh crore rupees that are unsold in the country. Or they may have been unsold for a number of reasons. They could be luxury, they could be in micro markets which have not worked well, they could be very expensive inventory, may not be affordable. Repurposing this inventory, investing in it, working with a co-living operator or a hospitality operator, because these assets are available at a deep discount, maybe even below cost. The ability to go in, rent it, make it available to families who want to stay together, because a lot of the young couples are moving back to families. They will need to move into larger accommodations. So if you can make these larger units, you can make these assets available to people who want to then rent it out, stay there together, liquidate their non-core investments. They may have bought a house near their workplace. They don't think they're going to be near the workplace anymore. They're liquidating that. They're happy to use that money, put it into an investment, and use the proceeds to actually pay rent. So very smart financial strategies at play amongst the millennials, amongst the young working professional couples who are looking to enter into larger rental leases. This is where entering into a deep discounted residential asset and making it available on rent through co-living operators is again a very brilliant thing to do, which is where we're seeing a lot of the NRI money coming back to India, buying these assets at a discount and letting them out. And yields are going up. I mean, the yields have already gone up by 50 basis points since last year. We're at an average of 3.5% yield. In co-living operations, the yield may inch up to 6-7% as well. So suddenly this, and of course, because you're buying at a rock bottom price today, the capital appreciation upside potential is very large. So that could be the fourth thing that one can do at these times. And of course, now we are also hearing that we may have a new REIT in the market. The first REIT did really well. So for a retail investor who doesn't want to get into a direct investment or a direct asset strategy in terms of owning, managing, exiting, the best opportunity is then to also look at a REIT. We will have a Raheja Blackstone REIT coming up. REITs have done really well in India. They've also done very well internationally. I think with the negative interest rate environment and subdued growth, REITs will tend to provide the largest safety margin of yields and capital appreciation going forward. And these are prime assets of the country. the mind space, and some of these are prime assets, and they will tend to continue to be in favor irrespective of the cyclicality of the market, and therefore backing your money on these assets and earning your returns from that, I think, is a great idea. So these 3-4 things actually make a lot of sense in today's time.
Yeah, so listening to you, I think the scenario is not that deep that people kind of make out to be. Smart investing, as you said, invest in distressed assets, probably opportunistic buying and repurposing, which is the main thing. Repurpose the projects and see the right fitment, right product. So, like we were talking about, you mentioned that NBFC banks are not lending right now, or very few are lending. There is an opportunity for PE and alternative funds as well. So, in terms of capital, what is the demand and gap supply? If you can give us the right figures for real estate, what is the gap?
Yeah, Sapna, it's a very, very stark reality that the total amount of debt on the real estate sector is close to about 9 lakh crore rupees. Almost about $20 billion of FDI got employed, largely, of course, to buy commercial real estate and some of the other built-up assets. Now, if I only look at the credit numbers, out of the 3.3 lakh crore rupees, almost 40% is held by NBFC, 60% is held by banks. These people are not employing any more money. So it is important that new money needs to get into the sector. Almost about 1.5 lakh to 2 crore rupees was a constant new demand of money, which was replacing old money as well as increasing the overall debt pie because of the new projects that were getting launched, but not necessarily getting sold immediately. So from a constant need, and the last 5 years, we've seen that almost 1.5 to 2 lakh crore rupees have been employed, either through banks or NBFCs and things like that. So from that current demand, which still persists, and in fact, the demand has actually gone up. So where last year almost 1.3 lakh crore rupees were deployed, this year the demand is almost 2 lakh crore rupees. And that 70,000 crore rupees has gone up despite the fact that 50% of the launches are down. So not new many project launches happening. But because there is a lack of internal accrual, there's a lack of cash flow, there's a lack of rent, there's a lack of repayment, there's a lack of ability to bring in the money on time from customers, from sales, the need for this buffer capital and the need to repay some of the existing lenders for demanding the money, the total demand outstanding is almost about 2 lakh crore rupees today. Against that, the available capital is less than 40,000 crore rupees. And I'm putting all the NBFCs, all the HFCs, all the funds together, and that is the amount of money available with them. Banks may also be able to contribute a bit, which is why it might look slightly larger than that. But most of the banking institutions and HFCs and DFIs that I know are on the wait and watch mode. They are not looking at increasing their sectoral exposure at all, or they're very, very selective doing it. So I don't expect a very large or meaningful number coming from banks in terms of new loans. And anyway, we are hearing of PSU banks consolidating. There may be an opportunity where there may be only 5 PSU banks. There will be a lot of privatization. So when the entire banking sector is in a flux, with consolidation, with buyouts, with shoring up their balance sheet, cleaning up the NPAs, we don't think that a lot of sectoral based lending or activities are likely to happen. There could be priority lending for SME, for agriculture, for some of the other, absolutely core agenda or core regulatory issues. But I don't believe that there will be, too much other capital available from the bank. So in that scenario, clearly we are looking at a gap of almost 1.5 lakh crore rupees. But that's a massive number, which also means that if you look at it, that not more than 20% of the players in the country will actually be able to find capital for themselves. True. 80% of the players will be having to abandon or give up their assets to somebody else or find another ways to monetize it. But capital will not be available to almost 75-80% of the players in the market. So it's a very, very, so there's a capital pandemic also, apart from COVID pandemic. There's a huge capital pandemic with the banking sector being in a meltdown, NBFCs being in a meltdown, not too much capital actually finding its way. So I'm seeing a huge financial pandemic. And while we may have a vaccine for COVID sometime down the road, I don't know whether we have a vaccine for the banking and for the financial sector yet, or if anybody's even working on it. And that is even more worrying for me, that there don't seem to be any concerted efforts to actually recognize that there is a financial pandemic and we need to create a vaccine very fast and stop this propagation of NPAs, stop this propagation of asset erosion, of capital erosion in the banking sector, and find a way to make the sector healthy, wholesome, and able again. because without a strong banking and financial institutional framework, industry will continue to struggle.
That's true.
So I clearly see that as a problem. Of course, there are certain measures being taken, including privatization of banks, raising new money through QIPs, IPOs, raising new debt capital offshore, etc. So there are short-term measures or interim measures being taken, but clearly, I think there's a worrisome gap right now in terms of the total demand-supply gap of capital.
Correct. I think what we need, as you rightly mentioned, systems and institutions need to be. We need to rework on that, and with a long-term vision. Short-term measures we are already taking, but long-term vision is very important. And while there are challenges, like you mentioned, there is a financial pandemic right now. We're looking at the gap of capital, which you just mentioned, which is huge. So while the challenges are there, potential also are there. You already cited them. What would be your top 3 tips for people who are looking at investing to get benefits without risking their investment? What would be the top 3 tips you would like to give?
I think the top 3 tips will be: real estate has been a legacy investment for families for generations. I don't think we should deviate from the core of the Indian ethos, where gold and real estate were the safe havens of investment. I think a belief that these asset classes will continue to be the prime assets for the generations to come should be intact. Financial securities have had their share of volatility, have had their share of shocks, and people have also realized that there could be a lot of downside issues with financial securities. In the last decade and a half, we have moved a large part of the India wealth to financial securities. I think it is important for some of that to get recalibrated and for investors to start looking at hard assets. What do I own? What is mine? What is it that somebody can't take away? Which is your house, your gold, your jewelry. I think that is absolutely essential. That preserve your assets, keep your assets with you. Your assets at will fare well. Even in the worst scenario, nobody can take that asset from you. A financial meltdown can't take that asset away from you. I think that is a very, very simple idea that people need to go back to. Right. So invest in gold, invest in real estate. Within real estate, buy something which is available ready, nearly ready at a deep discount. You can never go wrong with that. Buying a house, buying a land, buying an office which is ready, occupied, or can be occupied within a short period of time, can be let out, where you don't see any completion risk, you don't see any risk of getting stuck. You can drive a really hard bargain, get a 20% discount pre-COVID to now, and that will give you a significant upside. You can't go wrong with that. So that's the second thing that people should look at. Third, look at new assets like REITs. Park some money in a REIT. It'll give you a steady yield. The best of breed developers and global managers are involved. The best of global capital is involved. Always continue to do well in India, because there are so few assets in India that those few assets are likely to provide the best outcome. So we have only one REIT. There is a second REIT now. Very, very few assets compared to the global scenario. So given that those 5-10% of the cream assets of the country are available to you, I think that will make a lot of money to going forward, as you've seen in the first REIT. So those are 3 simple strategies. A, invest with a fund manager like us who will preserve capital, give you a steady return, churn your capital, give it back to you in 4-5 years, and you can keep on churning it, keep on getting your coupon, keep on getting your interest from time to time. Easy thing to do. Second, buy a direct asset. Keep an asset at home. Buy a deep discounted flat, buy a deep discounted land parcel, go and buy an office which is pre-leased and keep it for you. And third, go with a financial security like a REIT and nothing else. So very 3 simple things that people should do. Recalibrate the assets, because a REIT is finally a hard asset that you own a piece of.
Right.
You own a certain square foot, a certain percentage of that physical asset as a REIT owner. So that asset is not going to go away. It is one of the top 10% of the assets in the country. So you're a direct owner in that.
Right.
So whatever happens to the financial markets will not affect the REIT. Whatever happens to banks will not affect the REIT. Whatever happens with you or whatever happens with the economy will not affect the house, the land, or the office that you bought. Okay. What happens is not going to affect your investment in a manager like us. We put in 100 crore rupees of our own money before we take the next 300-400 crore rupees from investors. So we are so sure about what we are doing, about going after the end consumer, discounting receivables and bringing that money home every 12 to 24 months. It's a very, very simple thing to do, Sapna. it is easy to get confused, but it is very, very relevant that you stay stuck on these 2 or 3 ideas, and people will make a significant upside from real estate from this point onwards.
Right. Listening to you, I think, people do get very confused with finance and numbers and things like that. But as you said, it is very simple. Go with your traditional investing wisdom, go for hard assets, go for something which is ready and therefore non-risk, asset. And of course, you also covered the retail investors through REITs. If they want to buy property, they don't need to go with, large funds, but they can still own a piece of hard asset through REIT. So those were really fine tips, Amit. I think you shared it with our viewers. Thank you so much for your time, and it's a pleasure speaking to you. Thanks once again for being here with us.
Thank you, Sapna. It's a pleasure too. I wish you and Realty Plus all the best. You're doing extraordinary service in educating the readers, in bringing stakeholders of the sector, including developers, fund managers like ourselves, consumers, distributors, all on a common platform to create an idea that is going to make our sector and our industry much more stronger, more transparent, and more reliable going forward. So thank you too.
Thanks, Amit. Thank you so much.
Thank you.